Beatrix Whipple with the Whipple Group, and today I'm going to go over the most recent iteration of the California Residential Purchase Agreement, otherwise known as the offer. There's been a lot of changes throughout over the years, and the most recent changes were the most significant, both in terms of the way things are laid out, time periods, and most significantly, buyer's broker's compensation. So hang tight. I'm going to minimize myself on screen, share my screen with you, and go over everything page by page. Okay, so this is the first page of the purchase agreement. This is an addendum called a real estate agency relationship disclosure, which what it does is it identifies who is representing who. Whether you're a seller's agent or a buyer's agent, the form looks the same. In this case right here, you can see that the buyer is checked off, and it really is intended so that everyone understands what everyone's role is and who is representing who. When you are representing either a buyer or a seller as an agent, you have a fiduciary duty to them and to represent their best interest, disclose anything you may know about the property that could affect its value or desirability, and ensure that their best interests are being met and supported throughout the transaction. So you can see right here, buyer is checked. Keller Williams Pacific Estates is the brokerage that I hang my license with. Their license number is right here, and I am an agent of Keller Williams Pacific Estates. My name is right here. My license number is here. All right, so we're going to move on to the next page of this. Oops, let me change the view on this. View, single page. So this is the second page of that. It is just informational. And then this is the first page of the residential purchase agreement, otherwise known as the offer. Let me grab my pen so I can highlight some things on here. So we would typically write in what date it's prepared, the buyer's names, the property address, the assessor's parcel of the property, which is the tax ID of the property. And we also identify who's representing the seller. This should really be checked right here. The seller's broker's name is here, their license number is here, the real estate agent working under that broker, his name is here, their license number would be here. And then this is if I was representing a buyer. So Keller Williams Pacific Estates is the broker that I hang my license with, and I would be representing the buyer, and my name is right here, and my license number is here. So this just identifies who's representing who again. Over here in this sample purchase agreement, I have an $800,000 purchase, a financed purchase, and it is a 20% down purchase. So you can see right here, the purchase price is $800,000. It's a 30-day escrow. So that's pretty standard for financed offers. 30-day escrow, sometimes 45 days depending on the circumstances. Sometimes it can be shorter. Some lenders can do shorter than 30 days. If it's a cash offer, this would be checked right here. All cash wouldn't be meaning that there's no financing. That can be faster, just depending on how quickly all the parties want to close and how quickly the seller can get the buyer everything they need to review in order to have done their due diligence in order to close. But we're going to go with the 30-day escrow just because that's kind of the standard for a financed offer. The initial deposit is the money that goes into escrow as your good faith deposit once your offer is accepted. Typically, it's 2 to 3% of the purchase price. In this case, I wrote it as a 3%. And this money goes towards your credits in escrow. Once we open escrow, there's a column for your credits and your debits. This is a credit. It offsets anything that is a debit to you, like your closing costs or your down payment. So this money goes into escrow and it remains refundable should you back out until you've released all of your contingencies, which you do in writing with your agent once that contingency has been satisfied. Once we get to the time periods on contingencies, I'll go over that a little bit more in detail. But just know that this money goes into escrow within 3 business days of acceptance of your offer. If it's not in escrow within that time, you are technically out of contract. The seller could cancel on you, and that money is refundable to you should you back out until you release all of your contingencies. Here's the loan amount. In this example, it's an 80% loan, 20% down, so your loan amount is $640,000. Unless you check any of these boxes right here, it's a conventional loan. If you're doing FHA, VA, or any other type of financing, you would check these boxes. If you do additional financing amount, which is very uncommon, you would have this filled out. And here you can see the balance of your down payment. So this number, $136,000, plus this $24,000 equals 20% of $800,000. So this number right here, 136 plus 640,000 plus your 24,000 equals 800,000. Okay? Let's move on to the next page. So right over here, if you were asking the seller for any credits, and oops, that's not a straight line. If you were asking the seller for any credits, like a closing cost credit, a preemptively decided upon credit, not a credit for repairs, this is where you would ask for it. So say you were making this offer and you wanted $10,000 towards closing costs. This is where you would put that in. I have buyers ask me all the time, well, would the seller consider a credit towards closing costs with this dollar amount of offer? And the best way I can explain it is a credit towards closing costs is no different to the seller's bottom line than if you offered that much less on the property. So let's say this particular buyer was asking for $10,000 towards their closing costs. To the seller, that is no different than an offer of $790,000. So you can ask for credits, you can ask for them, but just know that the seller will consider that credit as money off of the price. It is essentially the same thing to them, okay? Right over here, this is a big one. This is where the buyer asks the seller to pay their agent. As of August of 2024, the whole structure for how buyers, brokers get paid changed. It was detached from the listing and became the responsibility of the buyer to compensate their agent as outlined in the buyer representation agreement, which I'll go over after this. Right here, this section is where a buyer has the opportunity to request as part of the offer that the seller give a concession to compensate their agent and relieve the buyer of the financial responsibility of compensating their agent. I'm filming this in May of 2025. Since this change took place in August of 2024, every single transaction that I've been involved in and my team's been involved in, every agent I know has been involved in, the seller has agreed to compensate the buyer's broker. They may negotiate on how much to compensate them, but I have yet to have any buyers come out of pocket to compensate their agent. So that may change down the line. I don't know. As of May of 2025, this has been the case. If it's an all-cash offer, you must submit proof of funds for that. If it's not an all-cash offer, you still need to submit proof of funds for the down payment and closing costs. An offer is not considered complete without proof of funds and pre-approval letter. And that's what this is. This is the verification of loan application. And right over here, there's a few check boxes that identify what type of a pre-approval it is. There's a pre-qualification, which is the most light version of an approval. There's the pre-approval, which is a more in-depth version of a pre-approval. And then there's the fully underwritten pre-approval, which means that that buyer has gone through underwriting, is fully approved, and the approval is just pending on identifying the property. Okay? Final verification of condition. This is your walkthrough. So you have a right to do a walkthrough of the home prior to close of escrow. COE is close of escrow. And what the purpose of that walkthrough is to really ensure two things. Number one, it's to make sure that any repairs that were done, that were agreed to, that the seller agreed to do in a repair request have been completed to the satisfaction of the buyer. And two, even if there weren't any repairs done, it's to make sure that the property is relatively in the same condition as when they made their offer. You'll see in a subsequent page that one of the terms of the offer is that unless otherwise agreed upon in writing, that's the repairs clause. But there is a clause in this that says that the seller is obligated to deliver the property in the same condition as of the date of acceptance of the offer, unless they made repairs, which are agreed to on a repair request form. Assignment request, we really don't deal with this a lot. This is if the contract is assigned to another party. Okay, so here are contingencies. So I'll give you the rundown of what contingencies are. Contingencies are protections, milestones, and conditions of the offer. So when you make an offer, you do identify, this is how much I'm paying, this is how much my loan is, this is how much my down payment is, this is how long the escrow period is. But all of this is dependent on certain things happening. It's dependent on contingencies. It's dependent on the buyer getting their full loan approval. Even if they have a pre-approval, they need to get their full loan approval. Everything in the contract is baked in at 17 days, as you can see. However, it is very customary to shorten these time periods to make the offer more appealing. It is very uncommon in my experience for all of these contingencies to stay at 17 days. And the reason being is that sellers don't want to wait 2+ weeks, almost 3 weeks, to know if the deal's going through. They want you to do your inspection relatively quickly. They want the appraisal to happen relatively quickly. And generally the loan is the one that takes the longest time because there's a lot of moving parts with the lender and the underwriter, and that is usually pushed out the longest. So I'll verbally go over what we typically shorten these to, which I think is pretty standard. But typically the loan, we shorten it to a 14-day loan contingency. Your lender should be able to provide you your conditional loan approval by day 14. Which leads me to a caveat. Not a caveat, a tangent. When you receive your conditional loan approval, it will say, hey, your loan is approved pending XYZ conditions. If those conditions are not insurmountable, and they're going to vary case by case, a lot of times it's a paper trail. A lot of times it's a gift letter. A lot of times it's, hey, explain this deposit. A lot of times it's, oh, we need your tax transcripts. Whatever it is, it's case by case. But provided that those conditions are not insurmountable, that is when you release your loan contingency. A lot of first-time buyers are anxious to release their loan contingency until they have loan docs. That is not how you're supposed to do it. Once you have your loan approval, even though it's conditional, your lender should be able to tell you how complicated those conditions are, and provided that they're not insurmountable and that they can be satisfied, that is when you release your loan contingency. Appraisal contingency. Okay, appraisal contingency is the buyer's right to have an appraisal done, and it's actually the lender that orders the appraisal. The lender orders the appraisal to make sure that the money that they're loaning on the property does not exceed in whole the fair market value of the property. Because if they were to have to foreclose on the property, they want to know that they're not going to be upside down on it. If you have either a high down payment or the lender sees that the property is well within the values of the comparable sales, sometimes they waive the appraisal. But typically I would say 95% of financed offers do have an appraisal, and the appraisal contingency says that unless the property appraises at the agreed upon asking price, sales price, the buyer can back out based off of that appraisal contingency. It never means that the seller must reduce the price. Within a contract, within an escrow, if there are any disputes, the cure is always cancellation. With repairs, if there's a disagreement with appraisal, if there's a value difference and buyer and seller can't come to terms, the cure is cancellation. You cannot make a seller reduce their price. In some markets, it was very typical for a seller to say, hey, I don't want you to have an appraisal contingency. That doesn't mean that an appraisal doesn't happen. It means that even if an appraisal happens, regardless of where that appraisal comes in relative to the sales price, the buyer cannot back out based off of the appraisal contingency. They move forward with the sale regardless of what the appraisal value is, okay? And I made a video on that, on what happens if the appraisal comes in low. I made a video on that, and I can link that at some point, but that's a whole other video. Investigation of property. This is your inspection period. Whoops. Wow, that is a really, really, really bad. I'm bad at drawing. Their investigation of property is an umbrella, and there's a few different types of investigations under that. So number one is the physical inspection. That's your home inspection. You have the right to do an inspection on a property And it's typical for us to shorten this anywhere between 7 to 10 days for physical inspection. During your physical inspection, you have the right to hire any type of inspector you want, provided that you pay for it, it's within your inspection period, and they don't damage the house, okay? You can hire a medium to come in and make sure that the house isn't haunted, as long as it fits those three things. You pay for it, it's within your inspection period, and you don't damage the house. Most buyers of single-family homes do a home inspection, a general home inspection, a sewer scope inspection, which is like a colonoscopy for the sewer line. Sometimes they'll do a termite inspection if the seller hasn't already gotten a termite inspection, and then we will sit down and negotiate requests for repairs or requests for credits based off of those inspections. If a general inspector thinks that you need additional inspections, they can recommend those, but the three that I recommend are general home inspection, sewer scope if it's a single-family home, and a termite inspection if it's a single-family home. If you're buying a condo, there's no need for a sewer scope because the sewer line is part of the HOA responsibility. Termite is also 99.9% of the time the HOA responsibility, and they have their own schedule for termite inspections and termite work, okay? Under this investigation of property, there's also insurance, review of seller documents, common interest disclosures, review of leased or liened items, and I'll go through this one by one. So insurance, this is a new one. Now you have a contingency for insurance that says, hey, I've determined that I can get homeowner's insurance on this property because insurance is becoming a more difficult thing to obtain. So you have this, we typically write this at 14 days. Review of seller documents. These are all the seller disclosures. When you're in escrow, part of your due diligence is reading all of the seller disclosures. They're going to go through and list any past repairs, whether there's been a death on the property, even whether they're fighting with their neighbor. You have an opportunity to review all those. Typically, those are provided within, right here, 7 days after acceptance. So whenever you receive any statutory disclosure, including seller disclosures, you have 5 days from receipt of those to read them and sign off on acceptance of them. If they get them too late, it pushes that contingency out automatically. Preliminary title report. This is a title report that shows basically anything that's recorded against the title. I will help you read through this. They can be hard to decipher if you're not accustomed to reading them. So you have an opportunity to read the title report. And what the title report does, it works in tandem with your title insurance to ensure that there's no funky liens on the property, so that you don't buy a property that after closing you realize there's a mechanic's lien from a roofer that did a roof job on it that never got paid, and now there's like a $20,000 lien on the property that's clouding your title. Title must be transferred free and clear of any encumbrances, so any funky liens. Reading the preliminary title report ensures that there's nothing funky on there. If there is, it has to be cleared prior to going to the recorder's office to record in the buyer's name. Common interest disclosures. If you're buying a condo in an HOA, you have the opportunity and the right to read all of the HOA documents, the budget, the bylaws, the CC&Rs, the rules, the meeting minutes. I always say that the most relevant information is in the rules and the meeting minutes and the budget. The bylaws, the CC&Rs, all of that, it's a lot of it is going to be the same for most HOA communities. It doesn't have that much relevant information. That has information on how elections are held, kind of protocol for that. But the rules and the meeting minutes will give you the most relevant information on what's going on within that community. Review of leased or liened items. If a seller has solar and there's a lease or a lien on the property due to that solar, you have the opportunity to review all that. Sale of buyer's property. If you are buying a home and the down payment for your purchase is coming from the sale of another home, and you need to sell that home in order to get that down payment, you check that here. That's called a contingent purchase. And there is a form called COP, which stands for Contingency of Property, over here. So if you're buying a property and you need to sell another property in order to buy that property, that's where this would get checked, okay? Time of possession. Unless otherwise indicated, you get possession of the property as soon as it records title. We have no power influence or insight over when something records title. It could be 9 a.m., it could be 5 p.m., it's totally up to the county recorder's office. And what that recording is, it's recording of the deed of the title going in your name. So unless anything is annotated here or marked up, you get keys and access to the home. You get possession of the home upon notice of recordation, which you would get from escrow, and then we would tell you. Seller occupied or vacant units. Okay, so sometimes the seller needs to stay in the property after close of escrow. If everyone agrees to the terms, everything is handled in writing. There's a few different forms for that. If it's 29 days or fewer, it is a seller in possession form, which gives the seller a license to stay in the property. It's not a tenancy. Very different rights. If it's 30 days or more, then it's a residential lease after sale, where the seller becomes a tenant of the property, but everything is handled in writing. The seller is still obligated to hand over the property in the same condition as when the offer was made. Sometimes I have buyers come to me and say, oh, we can't let the seller stay in there after close of escrow. What if they damage the home? The seller is still obligated to turn over the property in the same condition as when the offer was made. It does not absolve them of any responsibilities. And I think that sometimes people see these horror stories, and for the most part, it's tenants. They're buying a tenant-occupied property, and the tenant doesn't have any skin in the game, so they don't care. And it's very rare, by the way, for this to happen, but the tenant could be difficult. It's more risky to buy a property with a tenant in place that's not the seller. In 23 years of doing this, I don't think I've ever had an issue where a seller remained in possession after close of escrow. They've owned the property for years. They're making a financial gain on the sale of the property most of the time. And they are legally obligated per the contract to turn over the property in the same condition as when the offer was accepted. If not, the buyer could take them to mediation or small claims court. So there's skin in the game, and everything is in writing. Okay, right over here are time periods for what the seller has to perform. They have to deliver their documents, like their disclosures. They have to return, both buyer and seller have to return their escrow instructions within 5 days of acceptance. Escrow instructions are more or less the forms, the terms of the contract transcribed onto escrow's forms, because escrow is a neutral third party. Everything that's agreed to between buyer and seller is also transcribed onto escrow's forms. I will help you go over escrow docs once you get them, but everything must be returned to escrow within 5 days of receiving those. You get those after you open escrow and submit your deposit. This is how quickly the seller has to pay for HOA docs. When the HOA company issues the meeting minutes, CC&Rs, rules and regulations, all of that, the budget for the buyer to review, there's typically a fee, and the seller has to order those items, escrow really does it, and pay that fee within 3 days of acceptance of the offer. Also, in California, there are only 3 things that need to be on a property for it to change hands, condition-wise. If buyer and seller agree to the condition of the property, it could be falling off its foundation. It could have no roof, but it must have smoke detectors in the bedrooms, carbon monoxide detector in the home, and if it has a tanked water heater, it must be earthquake strapped. Beyond that, it can be in any condition as long as everyone agrees. This is a California thing. So within 7 days after acceptance, the seller must make sure that these things are done. Evidence of representative authority, that's if like it's a trust sale or something. It's the paper trail of who has the authority to make the sale. All right. Over here, this next section talks about the included and excluded items. So a good rule of thumb is anything that's affixed to the property, bolted to the property, stays with the property. Chandeliers, mini blinds, shutters, things like that, stay with the property. Stoves, 99% of the time they stay with the property. Sometimes someone has like a vintage, like an O'Keefe and Merritt or something like that they want to take. They would disclose in the offer or a counter offer that they're taking that. Refrigerators are considered personal property. Sometimes people leave them. If this is not checked, don't expect it to stay with the property. Same with washer dryers. Dishwashers typically stay with the property, so we would check this. Microwaves, if they're built in, would stay with the property. Video doorbells, if you want them, let's make sure to check this off. Security systems, all of that, smart controls. So everything you want to check off. This is funny to me. This is always checked. I guess someone must have tried to take a bathroom mirror at one point. This is automatically checked. But these are all of the things that are included. If there's anything else that you want included with the property, like I have made offers for people where there was a statue in the yard that they wanted, and we would write it in right here. Excluded items. If there's anything that would typically be included, but you don't want it, say there's an ugly chandelier and you're like, I don't want that chandelier, I want them to take it. You would write it right here. Okay, here is the allocation of costs section. So this identifies who pays for what. It is typical to ask the seller, so let's check that, to pay for a natural hazard zone disclosure report. A natural hazard zone disclosure report is a third-party report, usually costs about $100, that tells the buyer whether the home is in a flood zone, fire zone, earthquake fault zone, etc. It's one of the reports that we review together during our due diligence period. Wildfire, we don't really deal with that here, but if you're buying in an area that has fire hazards, then we can ask the seller to pay for a wildfire report. The home inspection report, we would write this here, home inspection, is a buyer cost. The buyer pays for their home inspection. The seller typically pays for these minimum mandatory requirements that we went over on the first page of smoke detector, carbon monoxide detector, and water heater strapping. This section right here, Q5, most of the time this does not apply. This is government required point of sale inspection and reports. So in Long Beach specifically, there is an area, there are multiple areas that are parking impacted areas, which means that if you're buying or selling a home within those areas, the seller must have the city issue a parking inspection. If you're buying a condo with subterranean parking, it's exempt. You still have to get the report. It costs, I don't know, $30, something like that. The seller pays for it and they get a report saying, hey, this is in the parking impacted area, but the seller's exempt because it's a community garage. If the property has a private garage, whether it's a single family home or a condo with an own private garage, or even an own your own with its own private garage, the city must come out, if it falls within that parking impacted zone, verify that the garage is being used for parking. You can't have someone living in it. You can't have it set up as an office. And then there's some other things that they look at, like to make sure there's no loose wires or any health and safety issues. If there's any corrective action required on that report for it to pass, like, hey, get all your stuff out of there, it's being used as a dwelling, or clean up these loose live wires, this is where we say that the seller pays for those things to get done, or is responsible for getting those things done. And we can guide you on whether something is in a parking impacted zone. Outside of Long Beach, there are some cities, like I know Carson, I think this has changed, but Carson, the city comes out, looks at everything in the house, gives you a list of health and safety things that they want you to fix prior to the sale. In the city of LA, you have to have a earthquake shutoff valve on your gas meter. So certain cities have different things. We can help guide you as to what cities do and whether we need to check these things, saying, hey, the seller needs to do these minimum mandatory government mandated things. Okay, escrow fee. So it's typical to say each to pay their own escrow fee. Seller has their own escrow fees, buyer has their own escrow fees. Owner's title insurance policy. It is typical for the seller to pay for the owner's title insurance policy. Title insurance protects both parties from anything funky that may show up on title, like I mentioned before when we talked about the preliminary title report. The buyer's version of the title insurance is called the lender's title insurance policy because it's really protecting the lender, because the lender is the one who put the money up, but the buyer pays for their portion of that title insurance. Okay, now here's taxes and fees and everything. Everyone likes to charge a fee during a transaction. We typically ask for the seller to pay for the county transfer fee. If there's a city transfer fee, we also typically ask the seller to pay for that. Long Beach doesn't have a city transfer fee. Other cities do. If there's an HOA involved, the HOA charges a fee to produce the documents that the buyer gets to review as part of their due diligence, like the meeting minutes, the budget, the bylaws, all of that. It is baked into the contract that that is a seller cost. It is also baked into the contract that the HOA cert fee, which I'll explain, is a buyer cost. Whenever a buyer is getting a loan on a property that has an HOA, the lender needs to have something filled out that's called an HOA cert, otherwise known as an HOA questionnaire. It's a 1 or 2 page document that goes to the property management company and says, hey, how many units are there? How many of them are rented? How many of them are owner occupied? Is there any litigation? How many owners are delinquent on their HOA dues? And a number of other questions. And the reason for this is because while the lender is approving the buyer for the purchase, they also want to make sure that the property is in good standing. And if the HOA has a lot of issues, if there's litigation, it can cause it to be non-financeable. If more than 10, I think it's 10% is owned by one entity, it can render it non-financeable. If more than 15% are delinquent, homeowners are delinquent on their HOA dues, it can render it non-financeable. So the lender is making sure that the HOA and the community is also in good standing, and they use that HOA cert to determine that. If there's an ugly cert, meaning it's come back with answers that are not good, sometimes there's ways around that, but that can cause a deal to tank. But that cert, usually between $100 to $200, typically is what the HOA management company charges to fill that out. That's a buyer cost. HOA transfer fees, more fees. We typically ask the seller to pay for those transfer fees. Private transfer fees. In 23 years, I've never encountered a private transfer fee. So we usually either leave that unchecked or say seller to pay if applicable. Okay, home warranty plan. A home warranty plan is a third-party plan issued by, there's a number of home warranty companies out there, that covers most of the components and systems of the house. It's different than homeowners insurance. If your oven breaks, if your sink clogs up, if your refrigerator breaks, your home warranty can cover most of that. And you should ask us or your agent to give you a home warranty brochure that details what they cover, what those coverage limits are, and what it looks like if you were to utilize it. So if you utilize a home warranty plan, so this is good for 1 year. We ask the seller to pay for a 1-year home warranty plan, and right here we write how much we want them to spend. So we typically, in this day and age, put $750. We ask it to include appliances, any upgrades. We write all that in here, and we say, hey, we want the buyer to choose who the home warranty is because they're going to be the ones who have to deal with it. Occasionally, a seller may counter on this. Most home warranty companies are the same. But let's say your oven breaks. You can call your home warranty company if it's covered under your home warranty coverage. They dispatch a service provider that they contract with. You do have to pay a service fee anywhere from $85 to $100, and they will come out, fix whatever's wrong. If they can't fix it, they will replace it up to the coverage limits. Okay? Okay. Next page. Now this is going to go faster. So any other addendums that are part of this contract get checked off here. If it's tenant occupied, we check that off. If it's a probate, meaning someone passed away and the property's being sold and there's no will or trust and it went to probate, you check this off here. If it's a manufactured home, you check this off. Most of these don't get used in typical residential sales. Any other addendums here, and we can go over all of this when we're writing an offer. They're very rarely used, but if they are a part of our contract, we'll go over those on a case-by-case basis. And then these are baked in. There's some other addendums at the end of this that we'll go over. Buyer's Investigation Advisory, Wire Fraud Advisory, Fair Housing Advisory, California Consumer Privacy Act. These are baked in. We cannot uncheck these because they are, wow, I'm bad at drawing, baked into the contract. I'll go over those as we subsequently see those. All of this, these are all definitions of things, informational. Read over them, but we have probably covered these in a buyer consult or in my buyer booklet I've given you. If you're reading this online and you are not a client of ours and you want more information on these, reach out. We'd be happy to meet with you and have a buyer consult. Same thing. Oh, okay, here we go. Here's some fun stuff. Condition of property on closing. These are two things I want to touch on. Per the contract, every property is sold as is. That does not mean you are required to buy the property as is. It means that you have the right to do your inspection, but the seller is never obligated to make repairs or give credits for repairs. So here it says, unless otherwise agreed, which you would agree on a request for repairs, the property shall be delivered as is in its present physical condition as of the date of acceptance of the property, including pool, spa, landscaping, and grounds to be maintained in substantially the same condition as of the date of acceptance. Okay. So what this says two things. One, it says the seller's never obligated to make any repairs. You're not obligated to buy the property. You can do your inspection. You can even ask for repairs, even if they've said as is. If you don't like the seller's response and you don't want to move forward with the purchase of the property, say there's stuff wrong with it that prohibits you from wanting to move forward, you back out based off of your inspection contingency. This is why I never advise buyers to waive their inspection contingency, even if the seller's done a pre-listing inspection that they've provided. Inspectors are human. What if they miss something? You should have the opportunity to do your due diligence and get a home inspection. You don't have to, but you should have the opportunity if you want to. You do your home inspection, you send the seller a request for repairs, which you would write with us, and then the seller responds. Or they don't respond. They're technically not required to respond to a request for repairs, but usually they do. If they respond and you don't like their response and you don't want to move forward, you back out based off of your inspection contingency. You can never force the seller to do repairs or to give you a credit. The cure for any dispute is cancellation. Okay, and if you haven't waived or removed your inspection contingency yet, your deposit is refundable to you based off of your inspection contingency. Okay, here we go. Seller remaining in possession. This also talks about what we talked about earlier with seller in possession. Contingencies and removal of contingencies. Okay, so this talks about what the different contingencies are. We touched on this earlier. Loan contingency, it's the contingency saying that you must get your loan approved. No loan contingency. If you waive your loan contingency, it says, regardless of whether or not I get my final loan approval, I am moving forward with the purchase. This talks about appraisal. We talked about that earlier. This talks about if you waive your appraisal contingency, what that means. We talked about that earlier. We talked about all of this. This talks about some of the other disclosures that you get, that you review. We talked about all this. The HOA docs, you have an opportunity to review the HOA docs. Leased and lien items, you have the opportunity to review all those leases or liens. If they're, sometimes people get solar and instead of paying for it, it's a lien on the property. Okay, so let's talk about removal of contingencies. Even though there are time frames for when those contingencies are due, they don't automatically lift. It's not a passive removal. It is an active removal. What that means is you must sign a contingency removal form removing that particular contingency for it to lift. If you don't, the seller can then nudge you by issuing a notice to perform that says, hey buyer, I'm asking you to do this contractually obligated action, meaning contingency removal, because it's due, or I reserve the right to cancel. If you don't remove this contingency with whatever specified on the notice to perform, if you don't perform and remove this contingency that's due, within 48 hours, I reserve the right to cancel. It's always baked in at 48 hours. Operative word is reserve. The seller may not cancel, but they have the right to cancel at that point. Still requires 2 signatures because escrow is bilateral. But I've had buyers say, oh, our contingencies are due. What do we do? Well, you must sign a contingency removal form for that contingency to lift. It does not automatically lift. Okay. We already talked about this, all the things that are included and excluded. We already talked about this, allocation of costs, point of sale requirements. This is all definitions and explanations of things that we've talked about. More informational things on disclosures that the seller will provide. These are all different disclosures and things in the natural hazard zone disclosure report that we will read. Informational. All informational. These are all the things that you have the right to read the disclosures on and do inspections on. Okay. Title investing. This is, escrow will send you a worksheet on how to take title. There's different ways to take title. We can cross that bridge when we get to it. They typically provide you a breakdown of what the different ways of taking title are and how those affect you. Okay, we talked about this. Time periods, removal of contingencies, and cancellation rights. The way that the contract is set up, it very much protects the buyer. Unless the seller has a contingency, the seller cannot cancel on you unless you are not performing as a buyer. If you get your offer accepted and then the seller gets a better offer, unless you're not performing, meaning removing your contingencies within the time specified in the contract, the seller can't do anything about it. If you are past due on your contingencies, they can send a notice to perform and cancel on you. But once you're under contract, the seller is stuck with you unless you do not perform, unless the seller has a contingency. Typically, a seller contingency is, hey, we need to find another property. Otherwise, the sale doesn't go through. That is the most common seller contingency. 80% of purchase agreements, in my experience, don't have seller contingencies. But the only time a seller can cancel on you is if you're not performing, and they must go through the proper channels and issue a notice to perform for that to happen. If the buyer still doesn't perform, then the seller can issue cancellation. Okay, next page. This is more informational. We've talked about a lot of these things. Notice of buyer seller to perform, we just talked about that. Removal of contingencies, we talked about that. Removal of seller contingencies. Demand to close escrow. If things are lagging and the buyer's removed all contingencies and they still can't close escrow or are refusing to close escrow, the seller can issue a demand to close escrow. If that doesn't happen within the time specified in the demand, the seller can cancel, or the buyer. This talks about the deposit, again, which is refundable until you remove all your contingencies. It talks about repairs. We talked about that with the walkthrough. The walkthrough is the final verification of condition. We talked about that. Everything is prorated in escrow. So property taxes, all of that, everything is prorated. You never pay for what the seller is obligated to pay. Seller doesn't pay for yours. Okay. All informational. All informational. Definitions of things. Okay, these two are important. Liquidated damages clause. So if you get under contract and you go through all of your contingencies and you release them in writing, which you would do with me or your agent once that contingency has been satisfied, and then you try to back out at the 11th hour, the seller can try to keep your deposit as liquidated damages. Okay? Still requires 2 signatures because escrow is a neutral third party, but you are saying, yes, if I release all contingencies and then back out, the seller can try to keep my deposit as liquidated damages. Okay, over here, arbitration. This says, in a nutshell, if things get so ugly between you and the seller that you're threatening litigation, you agree instead to do arbitration. Arbitration and mediation is done in front of the real estate board. It's, in my opinion, probably the most beneficial because it costs less, it's faster, and the people who are deciding the fate of what happens, what you're arguing about, typically the deposit, are people who understand the purchase agreement inside and out. Say this was a small claims issue, if it was under $10,000. Say it was a small claims issue, and you went to small claims court. The people deciding the fate of whatever you're arguing about, usually the deposit, may not be as well versed in the contract and how it protects the buyer as mediation or arbitration, and they might say, well, you appeared as though you were going to move forward with the sale. you acted as though. So yeah, you lose your deposit. I mean, I don't know. That's never happened. I'm just speculating. But in my opinion, I think it protects both parties to agree to arbitration and mediation. More definitions of things, more informational things. This is the final page where you sign your offer. Signature page. If the seller is countering, they check this off here. This is where we sign. Okay. This is an addendum to the purchase agreement. This is the buyer's investigation advisory. This is a 2-page document telling the buyer that it's your right and your duty to do your due diligence, get a home inspection, read the reports from escrow, really satisfy yourself that this is the property you want to move forward with. It is the seller's obligation to disclose anything they know about the property that may affect its value or desirability, and it is the broker's responsibility to disclose anything they know about the properties or learn about the properties that may affect its value and desirability. 2 pages of that. Okay, possible representation of more than one buyer and seller. This sometimes means one thing on here, but always means another thing. Let me explain that. So over here, multiple buyers. Broker, in our case, Keller Williams Pacific Estates, may be working with many prospective buyers at the same time. That does not mean I personally have more than one buyer making an offer on this place. It means that Keller Williams, who I hang my license with, has more than just you as a client. That's all it means, and that always applies. It also applies for sellers. Keller Williams Pacific Estates, who I hang my license with, has more than just you, if you're the seller, as a seller. Dual agency. Okay. 2 things. If a buyer and a seller are both represented by agents under the same brokerage, say we make an offer on a listing that another agent in my office has listed, then it's technically dual agency because it's under the umbrella of the same broker. It's also dual agency if a buyer of mine is making an offer on a property that a seller of mine is listing, okay? Everything has to be disclosed so everyone knows who's represented by who. It's never concealed. Okay, this is important. Offers not necessarily confidential. Unless a seller has asked their agent to not disclose terms of offers, they're not necessarily confidential. A lot of people get this wrong. Whenever I reach out to a seller's agent trying to gain background info on what would be a competitive offer, I ask them, I say, hey, where would we have to come in to be competitive with what you have on the table? And a lot of times people are like, I can't tell you. Well, unless the seller has specifically said in the listing agreement, offers to remain confidential, they could. They could. They can say, hey, you'd have to come in at above this number. Or, hey, I've got offers at asking. Or I've got offers just below asking. Or I've got offers 20,000 over asking. They can say that unless the seller has specifically instructed their agent to keep offers confidential. In my opinion, I think it's best to give some insight so that we're not spinning our wheels making offers that aren't competitive with what's on the table. And then if a seller has multiple offers, it's also in the seller's best interest. Hey, you've got offers above asking. Let people know that they'd have to come in roughly in this range to be competitive with what's on the table so that they know what they're up against. It saves everyone time. There are cases where confidentiality is important, case by case, but offers are not confidential unless the seller has instructed their agent to keep them confidential. Fair housing and discrimination advisory. This is pretty much a no-brainer. It is illegal to discriminate for the agent, for the buyer, for the seller against any of these protected classes. No-brainer. Buyer's homeowner's insurance advisory. This is just telling you as a buyer that insurance is a volatile market. It's important to get homeowner's insurance. Here's some resources listed where you can find information on insurance. We can help you with this. We can help guide you to different insurance professionals. Wire fraud and electronic funds transfer advisory. All this says is make sure you know who you're wiring money to. There's a lot of wire fraud. Don't just wire money willy-nilly. Whenever an escrow company sends you wire instructions. Typically, they will leave a few numbers off the end, so you have to call them to make sure that you have the right wiring instructions, because there have been instances where someone's email gets hacked, a fake wiring instruction gets sent out, someone wires their money to some other party, and they never see that again. So typically when you're wiring your deposit or the rest of your down payment, the escrow company will leave the last few numbers off the wiring instructions, so you have to physically call them. This is how we hold phones. Call them to get the wiring instructions in totality, so that you have a human telling you, hey, this is the right number, so you know it's not some, fraudulent wire instructions that were sent to you via hacked email. Consumer Act. This just tells you that your information's not sold. It's just to make sure that they have the right parties on file. Okay, almost done. We are now to the buyer representation agreement. This is the 3-month agreement that you have with your agent that says, hey, we're working together. These are my duties as an agent to represent you, as a fiduciary to you, and everything else is wrapped up in this. So you'll recognize this. This is the same as what we saw at the beginning of the purchase agreement, the disclosure regarding real estate agency relationship. I'll go over this since I already explained it. I'll skip over this. Okay, buyer representation and broker compensation agreement. So right over here, this states how long the period is. It's not to exceed 3 months. If 3 months happens and it expires, you do another one. Type of representation, non-exclusive or exclusive. We only do exclusive, and I'll explain why. It's an exclusive relationship. We put our time, energy, and resources into helping you find a property. We only get paid at close of escrow. If we were to do non-exclusive and we were to work with you, and then you bought a home with someone else, we would never get paid. It would be like you going to work every day and someone else getting your paycheck. So we only do exclusive representations. If at any point you decide, hey, this isn't a good fit, we can cancel it. Property type. I generally don't check this, because if we check it and you decide on a different property type, we have to do a whole new agreement. Location. So for us, we service all of LA and Orange County. I just put those in there. Check this off, LA and Orange County. I generally don't itemize this on this contract because it doesn't matter. I have notes anyway. I know what you're looking for. We've talked about it. I don't need to put it in this. Properties excluded from representation. If you have worked with another broker and you have a representation agreement with them for specific properties, they would be excluded, which is where you would identify those. Okay, right over here, amount of compensation. What we charge for our services to represent a buyer is 2.5% of the purchase price. That is pretty common in our market. Sometimes a seller may come back after we have submitted an offer and said, I only want to pay, when you've asked the seller to pay, say, I only want to pay the seller or your buyer's agent 2%. That's fine. I'm not going to die on that hill. For me, it's more about the relationship. It's more about getting you the house that you want. I'm willing to waive that 0.5% because for me, you getting what you want in the relationship I have with you is more important than a transactional number. Most of our business comes from repeat clients and referral clients, and I know that if I do a great job for you and it's not transactional, it's relationship based, and I have your best interest at heart, you're probably going to refer me to your friends and family. So I'm not going to die on that hill, but what we write in here is 2.5%. We can always adjust this down on an addendum if a seller counters that. Okay. If they don't want to pay even 2%, which I have not encountered, we can figure that out because we still need to get compensated, but we can cross that bridge when we get to it. Okay. If you want to cancel this agreement, it is a 30-day cancellation. Hasn't happened yet, but it could come up that you say, hey, we don't like you. We don't want to work with you. We can cancel it. It is a 30-day cancellation. I don't know why it's written like that. I didn't write it. That's just how it is. Per this, the buyer is responsible for providing financial information to show that they are able to purchase within 5 days of signing this. And then If you don't have the money to pay your broker, you check this. So we know that we will only work with sellers who are willing to pay our fees, which in my experience since this came out has been 100% of sellers. Okay, this is just definition, informational, stuff that we've already talked about. Informational, kind of the same stuff that we talk about in the purchase agreement. And that's everything. This is the signature page. Buyer's investigation advisory, we already talked about this in the purchase agreement. This is another duplicate form telling you as a buyer it's your right and your duty to do your due diligence. Read the reports and disclosures from escrow and the seller, get a home inspection, seller's obligation to disclose anything they know about the property, broker's obligation to disclose anything they know about the property. Broker compensation advisory. This is saying that nothing is set in stone. Everything is negotiable. There are discount brokers, there are full service brokers. We are a full service broker. This is what we charge. It's not a set fee across the board. This also talks a little bit about that it's a requirement to have a written agreement with your broker as a buyer. We already talked about this, possible representation of more than one buyer or seller. This was part of the purchase agreement, so it's a duplicate form. Consumer Act. And we are done. We managed to get this all in under 1 hour. I know that was a ton of information. If you have questions on this, please reach out to me. If you're one of my clients, call me, text me, email me anytime. If you're not one of our clients and you want to know more about how we serve our clients, please reach out. We'd love to help you. And if you know anyone else we can help, or if you just have questions about the market, please reach out. Thanks so much.